In the AI boom, everyone is obsessed with answers. But what if the real secret, the actual intellectual property, isn't the answers at all? What if it's the questions? At a recent AI summit, NVIDIA CEO Jensen Huang said something that should make every executive and every investor sit up and pay attention. He said, "The answers are becoming a commodity. The questions are your intellectual property." Think about that. In plain English, your company isn't special because it can ask an AI to summarize a document. Your company becomes special because of what it chooses to ask, what problems it's trying to solve, and what it reveals in the process of asking. And that leads us to the part that everyone in business is quietly worrying about. If you feed an external, public AI tool your company's product roadmap, your pricing logic, the signals for customer churn, your legal strategy, or even just the internal questions your leadership is debating. You're not just sharing data, you are broadcasting your competitive instincts for the whole world to see. This is precisely why Huang says NVIDIA builds its AI systems on premises. It's not to protect the answers, which are becoming cheap and easy to get. It's to protect the questions. Here is a mental image for you. Answers are like electricity. They everywhere and getting cheaper by the day. But your questions? They're the blueprint to your house. You don't just publish that online. Now, if the legendary investor Charlie Munger were listening to this, he'd probably smile and say, "People finally discovered that what they're thinking is worth protecting. Took them long enough." This isn't a niche issue. This is a structural shift that's creating a massive new market demand. AI spending is exploding. Gartner forecasts that worldwide AI spending will hit around $2.5 trillion in 2026. That means AI will be everywhere, and so will the risk of data exposure. It's already happening. An Axios report found that over 4% of prompts and more than 20% of files uploaded to public AI tools contain sensitive corporate data. Gartner predicts that by 2027, 40% of AI-related data breaches will come from the misuse of these tools across borders. In response, countries are pushing for sovereign AI. With spending on sovereign cloud infrastructure in Europe expected to triple between 2025 and 2027. The conclusion is simple. Enterprises are going to demand private AI and hybrid AI. With the same urgency they demanded cybersecurity and the cloud a decade ago. It's becoming a requirement, not a preference. So let's put on our Charlie Munger glasses. Munger wouldn't get swept up in the tech hype. He'd ask one simple question. Where will the profit pool deepen and who has the pricing power? Let's map out the value chain and see where the money will actually show up. First, let's talk about chips and accelerators. If companies are moving their sensitive AI workloads into controlled environments on premises, in a private cloud, they need more computing power, not less. AI doesn't get rid of hardware demand. It just rearranges it, shifting from shared public systems to private inference, private training, and internal AI agents. The Munger-style take here is that these businesses can be wonderful, but the stocks can be a bad deal if they're priced for perfection. You want to buy when there's durable demand and a strong ecosystem lock-in, but you're not paying for 10 perfect years up front. You avoid them when the market is just drawing a straight line up forever. As Munger would say, even the best restaurant is a bad deal at the wrong price. Second, infrastructure, the networking, storage, and data center plumbing. Private AI isn't just about GPUs. It's about high-throughput networking between machines, fast storage for data, and tools for observability and uptime. This is the reinvention of the full tech stack. Companies in this space often have enterprise contracts, long upgrade cycles, high switching costs, and recurring revenue. Munger loved toll bridges, and this kind of infrastructure is the ultimate toll bridge for AI. You want to buy the businesses selling the picks and shovels to all the AI gold miners, the ones with repeatable service revenue that are deeply embedded in how enterprises work. Avoid the one-trick ponies that need to constantly reinvent themselves to stay relevant. Third, cybersecurity and data protection. If Huang is right, the sensitive asset isn't just your documents. It's the entire interaction layer, the prompts, the chat logs, the data sources, the actions of your AI agents. This creates a whole new set of needs for enterprises. AI-aware data loss prevention, defenses against prompt injection, model governance, audit trails, and zero-trust security for AI. The Munger-style take is that cybersecurity demand becomes non-discretionary once the board of directors wakes up to the risk. You want to buy vendors with a history of enterprise trust and compliance credibility platforms that become part of policy enforcement and are sticky. Avoid the checkbox security vendors with no real differentiation. As Munger might say, if it's easy to sell, it's easy for someone else to sell. Fourth, AI platforms for private model serving, governance, and something called RAG, or Retrieval Augmented Generation. To keep their questions private, companies will build their own internal copilots, use RAG over their proprietary knowledge, and fine-tune models inside their own controlled domains. This drives spending on model hosting platforms, orchestration layers, and compliance tooling. This is where a hybrid approach will dominate. You rent general capabilities from the cloud, but own your sensitive workflows. The Munger filter tells us the winners will be those with existing distribution into enterprises, easy deployment, and the provable return on investment. You want to avoid the AI wrappers? The thin products that are just a fancy fronthand on someone else's model and are easy to replicate. Finally, we get to end-user integration. This is where the value ultimately lands. Customer support automation, sales tools, engineering copilots, and finance and legal workflows. But here's the trap. The value here mostly goes to companies that already have deep domain data and process ownership. This means that just because a company is using AI, it's not automatically a good investment. You have to be sure they can convert that usage into higher margins and better customer retention. So let's summarize with a Munger style: what to buy and what not to buy. Charlie would lean toward the picks and shovels powering private and hybrid AI, the compute, networking, and storage. He'd like the security and compliance rails that become essential for AI usage. And he'd favor the enterprise platforms that already have distribution. What would he avoid? The hype-first AI stories priced for flawless execution. Companies with weak moats and easy-to-copy features. And the cash burners that depend on a friendly market to survive. Munger would put it this way: we don't get rich by guessing which rocket wins. We get rich by owning the steel mill and the toll road. So how do you actually invest in this theme? First, there's the toll bridge strategy. Own the durable enablers like infrastructure, security, and platforms with recurring revenue. Second, the barbell strategy. On one side, you have boring, steady compounders with enterprise stickiness. On the other, a small, limited exposure to high-growth AI leaders, but only when you can get them at a same price. Third, always apply the margin of safety rule. If your investment thesis requires perfect adoption, perfect regulation, and perfect execution, it's not investing. It's hope with a ticker symbol. Before you buy anything AI-related, use this questions RIP checklist. Does it help enterprises keep their sensitive interactions private? Does it reduce the risk of a breach or compliance friction? Does it have distribution to real buyers? Is the revenue recurring and is retention strong? And finally, does the business still work in a recession? The next decade of AI isn't just about building smarter models. It is about where AI is allowed to run and what it is allowed to touch. Once boards realize their employees are leaking corporate strategy through prompts, and regulators start caring about cross-border AI misuse, the demand for private and sovereign AI will become as normal as having locks on your doors. Or, as Charlie Munger might have put it, people finally learned, if you do and control your secrets, you don't have any. Thanks for watching. If you found this breakdown helpful, make sure to like and subscribe for more insights. See you in the next video.